Hi, everyone. Today, I want to talk about stocks I'm trading. Every Wednesday, I talk about the stocks that I'm trading this week. And first up today, Ford switches its CEO. Ford announced that they are going to retire their CEO, Jim Hackett, and Jim Farley, their chief operating officer, is going to succeed him. Next up, 3M has been having some troubles, but it seems like the business is turning. They say the stock has been under pressure since 2018. However, the company has enjoyed mid-single-digit organic revenue growth and double-digit growth in FY17. And lastly, for this episode, Dollar General earnings. They say it's hard to imagine the retailer struggling to generate much sales traction in the current environment. And this author remains long-term bullish on the stock. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying this 5-bed, 7-bath mansion in Jackson, Wyoming, or if you just want to be part of a well-educated financial community, definitely like and subscribe. It has a modern kitchen with a built-in breakfast table, as well as an interesting dining space. The master bedroom has all glass walls and an amazing view. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. Looking at the chart for Ford Motor Company, back in 2009, you could buy the stock for around $1.50 or $2 a share, and it rallied up to over $18 a share. Currently, the stock is sitting at $6.80, coming off of its $17 high. At these prices, I think the risk to reward with Ford definitely provides some opportunity. This is not to say that Ford does not have some troubles that it's going through, and recently they decided to change their CEO. As a response to the announcement, Ford stock closed 2.5% higher on Tuesday and was up 0.4% on Wednesday pre-market following the announcement. Both Ford and GM are down 26 and 29.5% respectively, and both Tesla and Nikola have gained 255% and 276% respectively. Looking at the graph here, you can see the vast difference in price between the two groups of automakers. An analyst from Strategic Wealth Partners said that they wouldn't be buying any automakers right here, and that they feel vehicle sales overall will decline for years, and that people will be putting less and less miles on their vehicles. Even the electric vehicle companies, which have been soaring, only made up around 3% of sales, and the profitability that they've been enjoying only comes from the sale of zero-emission credits, not from actual vehicle sales. The analyst expands on that, saying that Tesla has 10 times the market cap of Ford. Ford sold 367,000 F-Series pickups in the first half of this year, which is basically the same amount of Teslas that were sold all of last year. Despite the poor performance of Ford Motor stock, it seems like the down channel could be breaking, and it seems plausible that it could break to the upside. They say the stock has to break through the $10 level, and this is an example of making the story match up with the technicals. They say Ford does have a head start in the vehicle making industry, and as they move into electric vehicles, they could see more and more potential profits. My current position in Ford is the 650 puts, and those expire on October 2nd. I received a $23 credit, which means I'm still at exactly what I sold it for. Looking at 3M, you can see it had a pretty large bull run up until the beginning of 2018, and then we've basically been downtrending since then. It did hit the low in March, along with most other stocks, at around $125 per share, and it's since rallied up to $163 a share. It's really had some issues, but it seems like the company might be turning those around. So let's take a look at some of those problems, which was exacerbated by the tariff war. The tariffs are starting to impact pricing as well as sales, which caused the company's revenues to turn negative in 2018 and continue to decline in 2019. The company was expected to grow in 2020, however, the Rona has caused it to decline 13%. Even the company's healthcare sector saw a decline of 12.4%. Overall, the company's performance in the last 2 years has been disappointing, and they continue to miss earnings per share estimates in 4 of the last 8 quarters. Looking at the charts, you can see what I mean. This is a chart of quarter versus earnings per share percentage. So all of these red lines is when they underperformed their expectations. and you can see it's been back and forth basically for the last couple of years. And as a result of this, you can see the chart continues to downtrend. 3M is currently trading at 19 times future earnings and 17 times 2021 earnings, with a bonus of a dividend yield of 3.64%. This is where the author thinks the company is starting to turn around. They reported that July sales were up 6%, and half of that was considered organic growth. This leads us to believe that sales is increasing. In that third quarter, we could see the highest year-over-year growth in more than 2 years. Looking at the modeling, they've basically been flat year-over-year in Q3, which is a good sign considering the situation, and there's a chance that it could be positive, leading to an upward revision of estimates. On the margin front, the company continues to improve and has suggested its operating margins are between 20 and 21%. And as a result of this, the author thinks that it's going to go up from here. China has done a good job at controlling the Rona, and sales were up in July at 13%. This would reduce a significant headwind for the last couple of years, and it should help their results. The company's Chinese business has been enjoying higher margins, which has added to the company's advantage. Overall, 3M is not a bad business, and some of its end markets and geographies haven't performed as well in the last couple of years. But even during those years, 3M has been able to continue selling price increases in excess of inflation. They've also identified a couple of key areas like automotive electrification, advanced wound healthcare, safety, and air quality, which catalyze medium to long-term growth. It's easy to see that execution over the last couple of years has not been great, and the management does not get a free pass to continue to underperform. But right now, the stock is cheap, and some investors may be getting involved. Like Ford, they also had a CEO leave, and it's probably due to the fact that they continue to miss earnings estimates. Right now, expectations are pretty low for the company, like maintaining single-digit growth, like they are currently seeing in July, and the author believes it could return to a 20 times earning estimate for 2021. That price target is around $180 per share, giving it around an 11% upside. If you include the dividend, that would be a 15% return over the next year and a half. My current position in 3M is the 150 puts, and I received a $145 credit for that position. That means I'm willing to buy the stock at $150, and the current stock price is $164.18. The current value is $97, which means I'm at around a $50 profit, and the expiration is 25 September. Looking at the last stock for this episode, Dollar General. So you can see here in the March dip, it got all the way down to around $139 a share. And since then, it's been on quite the tear, all the way up to $204 per share. Looking at the 4-hour chart, you can see it's been on a pretty steady uptrend, up to its current $206 per share in after-hours trading. So let's take a quick look at the earnings preview. Will Dollar General drop the mic once again? A few retailers have reported earnings in the last few days, and Dollar General has been one of the most impressive in the retail space. The stock continues to outperform the S&P 500, as well as the retail sector ETF XRT by an even wider margin. Analysts expect revenues to increase at a pace of 19.5%, which, if achieved, would represent a deceleration from last quarter's growth levels. Earnings per share would be $2.44, benefiting from the gains of scale and growing at a slower rate than it did in the first quarter of 2020. They say that Dollar General should benefit from the stockpiling blitz of non-perishable household items, and government support in the form of direct payments and increased unemployment benefits will further this cause. Heavier revenue with a mix of consumable products compared to seasonal and apparel, as well as the unwavering pace of the opening of new stores and its dominance in rural areas. More specifically, on second quarter, big box retailers like Walmart have shown their ability to continue robust growth, and peers like Target and Costco are doing an even better job in the last few months. Looking at my position in Dollar General, I sold the $195 puts for August 28th, which is after the earnings report, and I was able to receive a $185 credit for that position. Let me know down in the comment section what you think of Ford stock. Is it a dud or will it break out? Will 3M turn around their decreasing revenue flows? And can Dollar General continue its rapid growth? Like and subscribe if you got any value out of this video. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to the jelly. So today's jelly is longtail riverboat racing in Bangkok, where they essentially strap car motors to very small boats and go very fast on the rivers.
Every time somebody goes past me, they're just so shocked to see me in one of these boats. Fucking amazing. Dude, we're rolling out. Okay, we're really moving.
Clearly, they are going very, very fast. And I'm sure they put a lot of work into that boat and that motor. But if they were to hit anything at that speed, that would basically be a wrap. Comment down below what you thought of this video. If you want to watch the full video, it's linked in the description. Like and subscribe before you go. And have a great day.